Thanks for clicking! The Toronto Regional Real Estate Board has released its data for the month of September, showing price decreases and dismal sales numbers. Yet, if you read any headline anywhere, you'll see the media once again parroting its board masters that home sales are on the rise, with buyers taking advantage of lower interest rates.
No, I'll do anything, whatever you say.
Yet, a barely conscious look at the data shows that there's not anything spectacular going on with Toronto's sales numbers. If anything, and I think it was only the Globe and Mail that mentioned this, it's the listings data that is the real story. But while the media falling down on basic literacy and ethics is nothing new, we do have a new report out from UBS showing that Toronto is in 5th place in the world for risks of a real estate bubble. The report, as we'll see, reiterates what we've discussed on this channel, that a market surge, that a market revival in 2025 is not a guaranteed certainty, and will depend largely on the economy.
What?
So what I want to do today is go over Toronto's real estate data for the month of September, focusing on those surging sales numbers, then take a look at that report coming from the UBS, and finally go over some implications. As we'll see today, sales aren't really surging in Toronto. But with October coming up next month, that's going to be the real test, especially with so many arguing that prices could go to the moon with those new mortgage rules set to take effect in December. We will obviously have an update out on October's data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home that represents the most popular set of features, and the benchmark was down in September. The benchmark in August was sitting at $1,082,000, and that fell about $14,000 to $1,068,000 in September. So, the benchmark price is down about $14,000 since last month, but also down about $60,000 since September of 2023, back when the TRREB noted that record population growth would bring the buyers back in 2024.
I can't find them.
With that said, the average price was up in September. The average price in August was $1,074,425, and that jumped just over $30,000 to $1,107,300 in September. So the average price up about $30,000 since last month, indicating more homes were sold at the higher end, but still down about $12,000 since September of last year. And the median price also bumped up as well. The median price, if you'll remember, that's where half as many homes that are sold over that price, and half as many are sold under that price. The median price in August was $925,000, and that jumped up to $950,000 in September. So we have a $25,000 increase in the median price since last month, but the median is still down about $10,000 since last year. And the amount of relative inventory is up as well. If we look at the months of inventory measurement, the MOI, which measures if no more homes came to the market, how long would it take for Toronto to completely run out of homes for sale? The MOI in August was 3.3 and is now sitting at 3.4. And that's the highest month of inventory that Toronto has had in the month of September for the past decade.
So let's not focus on that.
And finally, the sales to list price ratio, which measures by how much over or under asking a home sells in Toronto. So if a home is listed at $100,000 and sells for $99,000, the SLPR would be 99, and that measure remained unchanged in September, sitting at 99 in August and 99 last month as well. So in total, we have the benchmark price down about $15,000, the average price up about $30,000, the median price up about $25,000. We have a bit more relative inventory sitting on the market, and homes are still going for under asking price. With all of that said, you'd have to be living under a rock to not have heard that sales are surging higher in Toronto. And that is in fact nominally true. Last year we had 4,606 sales in September compared to this year's 4,996, an 8.5% increase, which does appear to be a big increase, except if you pull the data from the past 10 years, you'll see that this September was the second worst September for sales that Toronto's had in the past decade.
It's incredible!
Further, let's remember that last year's weak sales numbers came amid uncertainty from the Bank of Canada after it had just raised rates twice after pausing, so there was a lot of uncertainty going on last year. And while some are pumping the month-over-month increase in the number of sales coming out of Toronto in September, if we look at the data, we can see that it's not exactly atypical for sales to increase in September. Looking at the 10-year average, we can see that sales usually decrease by 0.8%, but if we take out the outliers of the pandemic bust and the pandemic boom, we can see that sales are usually increasing in September by 0.86%, which is higher than the 0.42% that we're seeing this year. And that is in fact a problem, as we really should be seeing much more sales activity in the market. Last year, at this time, there was a lot of uncertainty. The bank had just hiked rates twice, and we could have seen more. Whereas this year, the bank has now cut rates 3 times and opened the door for much further cuts. So, really, we should have expected much more sales activity, especially since the media has been promising it so much. Remember when 72% of Canadians were going to jump into the market once we saw rate cuts? Well, we have, and they haven't. So, these sales numbers are really not all that spectacular, especially compared to the past 10 Septembers, especially compared to the increase in sales that we usually see between August and September. Yet, article after article after article, all pumping the increase in sales numbers that we saw last month.
I'm tired, boss.
And these lack of sales, of course, coincide with a major increase in new listings, coming in at 18,089, the largest amount of new listings that Toronto has seen in September, save 2020, for the past decade. And with so many listings coming to the market and a dearth of sales, despite what the media tells you, that's a lot of inventory sitting on Toronto's market, a lot of active listings, coming in at 25,612, the highest number of active listings Toronto's had on its market, again, for the past decade.
You see nothing. Now beat it.
And we really shouldn't be seeing this amount of inventory coming to the market. Looking at the past 10 years of August to September, new listings usually increase by about 28%, 33% if we take out the COVID years, but this year we saw a 44% increase in new listings between August and September. So, as to what's actually noteworthy, yeah, it's the sellers, it's the listings that are coming to the market, despite what we're seeing in headline after headline, with really only the Globe and Mail pushing focus onto the listing side. So, we have a massive amount of inventory sitting on Toronto's market, we have a lot more listings coming to the market than we would expect, and we have much fewer sales than we would expect as well. So, is Toronto at risk of further price drops? Well, according to the much-cited UBS survey, that could in fact be the case, though there are some caveats. As mentioned, Toronto ranked 5th on the Global Real Estate Bubble Index, which measures the risk of a housing bubble, behind that of Miami, Tokyo, Zurich, and Los Angeles. And by bubble, what does UBS mean? With a real estate bubble, UBS is referring to a substantial and sustained mispricing of an asset, the existence of which cannot be proved unless it bursts. And by mispricing of an asset, UBS means a decoupling of prices from local incomes and rents, and imbalances in the real economy, such as an excessive lending and construction activity. So what UBS, a multinational bank, is saying is that non-bubble prices should be supported by incomes. In a sharp contrast to what we constantly hear from Canada's financial elite, there's a direct link between the price of a thing and people's ability to afford that thing. As we've discussed before, you can have 1,000 people in a room in $1 million house. If all of those 1,000 people are unemployed, they're not buying that $1 million house.
Oh, yes, they can.
And although Toronto's bubble risk has remained elevated, the UBS is knowing that the risk has declined at least a bit over the past few years, as rents and incomes have grown slightly. With all that said, UBS says that it does expect some price growth with the Bank of Canada cutting rates. However, the ban on foreign buyers, rising inventories, and a subdued economic outlook will prevent a quick resurgence of the pandemic real estate boom. So yeah, that's what we've been talking about on this channel. That even though the Bank of Canada is cutting rates, it's not cutting rates for no reason. It's cutting rates due to the weakening economy, which will keep a lid on prices. And UBS noted this when discussing the nature of bubbles, noting that a change in macroeconomic momentum, a shift in investor sentiment, or a major increase in supply could trigger a decline in house prices. And, as we saw today, we do have a major increase in supply, the highest amount of active inventory for the past 10 years. And we've discussed the struggling environment for investors on this channel in previous videos. And now, over the next few months, we'll see how the economy fares in the wake of the Bank of Canada rate cuts. So, in many ways, this study, making its way around the news, is confirming what we've discussed so much on this channel looking forward to 2025. That, although the Bank of Canada cutting rates is going to provide some support, everything going into 2025 will be largely dependent on the economy. How much money gets pulled out of the economy vis-a-vis the renewal wave, how much is being pulled out vis-a-vis Canada's debt to income, Canada's record debt levels, and how much gets put back in, how much are Canadians willing to pile on the debt, with the Bank of Canada set to cut rates even further. All of these are big unknowns. What UBS is saying is it's just not as simple as the bank cuts rates and we're going to the moon tomorrow. As such, as always, as we've discussed on this channel, do not try to time the market. As we're seeing right now, exogenous factors can very well come into play, and no one, I mean 0 people, can tell you exactly where the market is heading in 2025. If you like the house, consider buying it. If you don't.
Do you realize what you've done?
We will obviously continue to track Toronto's market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.